The topic of the moment is President Trump's tax records. And as usual,
yes,
you have an unconventional point of view. The implication for many, Nassim, is that the fact that he appears to have lost so much money is a bad thing that somehow disqualifies him from being the president.
I don't think it's an unconventional point of view, but I think it's entirely normal to feel that insulting entrepreneurs because you hate Trump is not a good idea. It's very shameful.
Explain.
They're insulting entrepreneurs. This country was built by entrepreneurs because it makes it respectable to lose money in the pursuit of, it helps economic growth and other things. 99 entrepreneurs fail for every one who succeeds that you show on Bloomberg TV, okay? For every person you saw on Bloomberg TV, you have 99 who failed, who had absolutely no money, probably not even driving a taxi. So these people, so you're insulting failure of entrepreneurs, and I think it's similar to insulting a soldier because he or she have lost a finger or a limb in battle, okay? It's within the same class of things, shaming risk takers when we need these risk takers.
So how should people look if we're taking these Trump tax records, he loses hundreds of millions of dollars, how should we look at that?
You want to comment on Trump, but don't go in and insult entrepreneurship, okay? Particularly risk-taking people who make this country great, okay? Insulting risk-taking for the sake of harming Trump is not acceptable strategy. It's not acceptable. It's
false equivalency
for all. Of course, beyond that, it is shameful. It's like biting the head that fed you. Look at the New York Times. How many people have tried and failed, to get a newspaper that pays them a salary? Okay, so they're not looking at a cemetery of failed entrepreneurs. It is insulting.
So the lesson is that we should look at someone's losses and say, thank goodness somebody is willing to lose money.
That's exactly the point. This is what made America great. This is what continues to make this country. I mean, you and I came to this country because we like the fact that it makes failure acceptable. I've lost a lot of money. I'm proud of it because at least it's a lot better than sitting on the sideline collecting a salary. Who's going to bring that salary? Entrepreneurs, risk takers.
Nassim, this is part of a bigger conversation about capitalism. As you know, Ray Dalio, the founder and chairman of Bridgewater Associates, has ignited a debate over the state of American capitalism. He says there's something wrong with it. What do you say?
I like Ray as a person. I like him personally. But I think this point of view is profoundly mistaken. Because it's not capitalism that's wrong. It's absence of skin in the game that is wrong.
Going back to risk-taking.
Going back to risk-taking. Absence of accountability. You have people making decisions, all right, that harm others without being harmed. That's not capitalism. That's corporatism.
Who are you talking about?
What I was saying, the structure that we have today.
Because Ray has skin in the game.
Ray had skin in the game with his fun, but he doesn't really project it to society where we have centralization of people in Washington making decisions like Alan Greenspan, that affect this whole country, and when people, are harmed, they don't pay the price.
Well, that person is Jay Powell now, the chairman of the Federal Reserve.
Yeah, but he's more responsible, okay, because he understands the job of the Federal Reserve should be minimum harm, not policies that may entail side effects. More generally,
you think Jay Powell gets that better than Alan Greenspan did?
He gets it a lot better. But of course, he's not the great Volcker. Okay, not yet. Okay, he hasn't shown it yet. No, let's go back to the core problem. Is you want to live in a society that is decentralized enough that people who make a mistake are also harmed by their mistake, not just inflict harm on others.
Not bailed out.
And what happened is we have evolved into, thanks to a large state, to a situation of corporatism. Those close to the state are bailed out. It's crony capitalism. That's not capitalism. Crony capitalism.
How do you fix it?
There are a lot of I wrote a whole book on it. the skin in the game. I wrote a whole book about it. Skin in the game. So
for those who haven't read the book.
Okay, so the idea is locally, first of all, it's shameful to make a recommendation without being harmed, okay, if something goes wrong. A forecast without having some skin in the game in a sense being harmed by it. How you structure a society in a way to be
But do we need smaller companies? Is that the answer?
What happened is the minute you decentralize, It'd be like Germany when you decentralize. What happened? Why do you have large companies? Because a company becomes powerful, start leeching on a state. And then you have a positive feedback in companies.
So not necessarily smaller companies, but less powerful companies.
If you'll have less powerful companies. In this country, as a consumer, I used to have enough power against companies because via the legal tort system. But then when the companies become large, as they are now, all these giants, they can control Washington, control the law via lobbyists, and perturb the natural mechanism of life and death of companies.
Nassim, some people think we can fix what's wrong with capitalism, so to speak, by employing new forms of monetary policy, modern monetary theory, for example.
I think that's lunacy. In my opinion, a lot of risk-taking. Saying something may work, okay, you got to look at consequences if it doesn't work. Now, we know the consequences is that theory is wrong.
How do we know that?
Well, I mean, first of all, it's sort of like, how do we know that if we don't experiment with, some nuclear device, it won't be harmed? So we know that it's not a prudent policy, okay, to engage in things that may create hyperinflation. And once you have hyperinflation, then again, we've got to bring old Paul Volcker. He's 95 years old? You got to bring him back because without him, we'd be in trouble now. So, and you know what happened during
these days about hyperinflation when there appears to be so little inflation.
I understand, but the problem of inflation is that very nonlinear. So it's like the ketchup bottle. Nothing comes out and then suddenly things jump out. So you have to worry about it. But I'm more concerned about the more general situation today, actually, than talk of MMT, because people realize it doesn't make a lot of sense. Is that we're in a situation where we have record low unemployment, or they say, so they claim. Plus, what do we have? We have a huge deficit.
Yes, we do.
Okay, so explain to me
growing. Which
one is wrong? Because so which one is wrong? Okay, so unemployment or the deficit? So in other words, the story is delivered by which one of the two? I think that we have a problem, okay, a cumulative deficit, because if we have a recession, then deficit would explode. And if we have an expansion, raising rates will cripple visibly the mechanism of growth, because
it's going to raise the cost of servicing that debt.
Servicing that debt, we already have north of $300 billion of just interest, from previous debt at record low interest rates. So you can imagine the results of. So we're not in an enviable situation. So this is why I'm worried.
You're worried?
Yes.
Are you worried at all?
I'm worried mostly about deficits. Employment can go. Deficits are very hard to control.
Yes, but employment gets people elected to office. Controlling deficits does not.
Maybe, but at some point, people are not as stupid as we think. You see, they understand if you reason with them, if you deliver the right message. Take Germany. Germany, they're obsessed with deficits.
They are.
Because their grandparents or great-grandparents, okay,
lived through hyperinflation in the 1920s.
That, exactly. And they know what can happen. They don't want it to happen. Okay. People in Argentina, people in Turkey, people in Zimbabwe, people in Iran, people in a lot of places, okay, sometimes communicate with them, and they tell them what happens when you have hyperinflation.
Nassim, are you at all concerned about the direction of the U.S.-China trade talks?
I have no. It's not much. I mean, it will take me. I usually talk about topics that take me about 20 years of reflection. So that's not my.
Something that you haven't given 20 years of reflection to.
We need. Well, given our relationship with in interviews, I'm sure in 20 years we could talk about it. We'll be here and we'll talk about it. But I'd like to talk about effectively that it is very foolish today to engage in any form of investment without considering huge tail risk. Because what would happen is, again, it's like ketchup in a bottle. They have risk accumulate, typically, nothing comes out, and then suddenly something may come out.
Okay. So people have drawn parallels between what's happening in financial markets today, the amount of risk-taking, the nature of the risk-taking, the reach for yield, the flood of foreign capital into particularly U.S. financial assets, drawing a parallel between that and what happened before the financial crisis.
Yes.
Now, the conditions look very similar.
Well, we have a lot of debt, but debt has shifted from private to public.
Yes.
Which is worse, because public debt doesn't go away. Private debt, you can always turn it into equity or punish the people.
You can restructure.
Yeah, exactly. Private debt is generated not by people who are responsible for the debt, but
there
by
is more public
civil
debt,
servants.
but there's still an awful lot of debt on corporate balance sheets today.
They are.
And a growing amount.
Growing, but I'm worried about public debt. I'm worried about both. Public debt is generated by people without skin in the game and goes out of control.
Politicians, in other words.
Politicians and civil servants. And bureaucrats. So you may have. So what I'm saying that it is prudent. The point is not to think what will happen, but what is a prudent policy. The prudent policy
is. Of course, but in order to inspire prudent policy, you have to give people a sense of what the future may hold. So what's going to precipitate a public debt crisis? We know it precipitated a private debt crisis because we can replay the movie of the financial crisis.
My idea is I'd rather be very poor at the timing and good at the hedging. All right. So you want to
that's
be
your business.
Yeah, that's my business. But that's also my philosophy in life. Okay. You don't want to try to depend on specific predictions of catalysts for that crisis. It can happen in an hour, or it may take years, all right? But definitely, we are in a precarious situation. I don't know when that malfunctioning plane will crash, but it will eventually crash. So you need some kind of protection from tail hedging that is done intelligently, not like foolishly, or stay out of the financial markets, which is what we recommend people.
Now, okay, so we're actually getting down to the advice part of the conversation.
Yes.
So if you're a professional investor and you want to take risk, you want exposure, you believe that one needs to have tail risk protection, in other words, catastrophe insurance.
If you know how to do it. If you don't know how to do it, stay out of it.
Or buy it. You can buy it.
You can. It's not easy because a lot of people think they deliver it and they run out of money quickly or something.
Okay.
It is a very delicate situation. I recommend that individuals stay out of the market.
You recommend pencils down.
Pencils down unless you know how to hedge, all right? And
few people do.
And few people do. Because,
so at this stage of the game, you would recommend that people have no exposure to financial assets?
Listen, you're not obligated to have exposure to financial assets.
Of course not.
It's not prudent.
Well, people want to save for retirement.
I understand, but you want to save for retirement. That's not prudent, because you got to look at both sides of the story. You may end up with no money.
What's the prudent allocation then? If you're trying to save for retirement, cash?
What I'm saying is that I engage in financial markets if and only if I have tail hedge protection, and it's done right. Otherwise, don't engage in financial markets.
Even in treasury bonds or bills?
No, especially treasury bonds. Interest rates. The upside from interest, from holding a bond that yields 2.4%, the upside is limited, and the downside is.
Well, that's only if you're interested in capital appreciation. If I hold to maturity, I'm still getting the 4% yield.
Yes, but there's the thing is, what if you want to get out? But that's our problem with holding to maturity. A lot of people don't know the horizon of their investments because they think, how many people get married thinking they're married forever? Half marriages dissolve before. So it's the same thing. You think you're going to be married to that investment for 10 years? You may have other things. You may change your mind. You may have a financial condition. You may want your cash out. Look what may happen to you.
Liquidity, in other words.
Your investment horizon, doesn't match your explicitly stated investment horizon. It's very hard for people to understand that.
So at what point in the investment cycle does it make sense for individuals to hold financial assets?
I would say I'd rather have very low return or close to no return than have a huge negative return.
Well, sure, catastrophic loss. Nobody can recover from catastrophic loss.
So a lot of people wished in 2007 and 2008, early 2008, a lot of people wished they had no investments. Okay.
Yes, this is true. But anybody who bought at the bottom in March of 2009 is sitting pretty.
Point. The point is, if you have a crisis, I'll be the first to buy. All right. And then, and the other thing is, I hate gold, but I'll tell you, skin in the game. I'll tell you what I own. I own gold, some gold.
That's it.
Some other financial instrument that would benefit from a collapse in bond market.
Such as?
It's complicated. derivatives. But and I would have, and I have some, the usual assets in my portfolio, but I try to avoid stocks, and I try to avoid bonds, long-term bonds. If you're going to go into bonds, go very short-term. And tail risk hedging, if you know how to do it.
It's not a very appetizing menu for people who are looking to generate a reasonable rate of return.
If you see all my books, I recommend people focus on their own job and not try to make money with their money, but try to conserve, because they could be very, very, very shrewd at their profession and extremely naive, okay, in their investment strategy. People have this notion that their savings need to be a income-generating, primary income-generating machine rather than preservation machine. The first rule is your savings is a preservation thing. And second, if you have some fat, some extra, then you could play with those.
What about these poor public pension funds with defined benefits that have to generate, actuarially a 7 or 8% return every year?
Tail risk hedging is necessary for these people, so they don't. Because the problem is, if you have a crisis, then you have to generate much higher return later. So you need to be able to have a higher exposure to risky assets, coupled with more tail risk protection.
So in other words, you need to be able to generate something in the double digits to survive.
In other words, if you have the point that we've looked at markets, what tends to happen is that markets go up and then crash.
And then they crash.
You want, but net they're good, okay? But to be able to sustain a crash,
to live through the cycle,
you could probably take more risk if you have the right protection or the right hedging,
as opposed to being conservative and just trying to generate a consistent 6 or 7 or 8%.
Conservative in the middle doesn't work well. You should have a portion of your portfolio in higher risk, but then have good protection against that high risk done properly. It's not. A lot of people think they can call a broker, buy puts, and it's done. It's much harder